Stocks. Stocks are one of the easiest ways to make money. People invest in them and wait for their money to grow. But here's the thing. 99% of them lose all their money. But why? Because most people don't know the basics of what the stock market is or how it actually works. So, we'll cover what stocks are, how they work, and why do people actually invest in them instead of keeping their money safe in bank accounts. So, hey guys, welcome back to Money and Habits, where we make money easy to understand. So, what exactly is a stock? A stock is like a small ownership in a company. When you buy a stock, you literally own a small piece of that business. Think about it like this. Imagine your favorite company is like a jar of candies, with thousands or even millions of candies in it. Each candy is what we call a share. When you buy a candy, you're basically saying, I would like to take this small piece of your company. Or in simple words, imagine YouTube has 10 shares. You buy 5 of them, you actually own half of YouTube. Just like this, in reality, big companies have millions of shares, so you likely own a very small percentage of that company. But the concept is exactly the same. But if you're wondering, why do companies sell these important shares to random people? Then it's because running a big company is really expensive. Business need more money to buy better services, build good products, open new factories, or simply expand their business all over the world. That's why companies sell their shares to raise more money. If they went to a bank for a loan, they'd have to pay it back with huge interest. Instead, by selling small pieces of their company, they get money that they don't need to repay, and they can use it to grow the business. Let's make it more simple with an example of Alex and his bakery business. Imagine you have a friend named Alex. Alex wants to open a bakery that makes really delicious bread, but he calculated that he needs $100,000 just to start the business. The problem is, Alex only has $50,000. Instead of taking a loan from the bank, Alex decided to divide his business into 10 equal shares. Since he's putting in $50,000, he keeps 5 shares for himself, which means he owns half the company. Now, each share costs $10,000. You and 5 of your friends believe Alex's bakery will be successful, so you each buy 1 share for $10,000. You altogether own 50% of the company, and now Alex has the full $100,000 he needs to open his dream bakery without any trouble. After 5 years, Alex's bakery becomes really successful and everyone's favorite. He now owns 5 new bakeries in different locations, and the business that was once worth $100,000 is now valued at $500,000. Remember, you and your 4 friends who invested $10,000 each for 1 share, your 10% ownership is now worth $50,000. If you decided to sell your share, you'd make $40,000 profit. Isn't that cool? But not every investment is a success. What if Alex's bakery couldn't compete in the market or failed to make profits? The business value might drop from $100,000 to $60,000, and your $10,000 investment would then be worth only $6,000, meaning you lose $4,000. This is how stocks work, just on a much larger scale. This is why you should always research a company before investing. Look at the things like what the company does, profit, debt, growth, future potential, dividends. And the most important rule is, never invest in a company you don't understand. Now let's talk about stocks. There are 2 main types of stocks, the common stocks and the preferred stocks. Common stocks. Common stocks belong to both big and small companies, and their prices can move up and down very quickly, sometimes even within a single day. When you own common stock, you get voting rights in the company. Yes, the real voting right. 1 share equals to 1 vote, which allows you to help choose company decisions and the board of directors. Common stocks companies do not always pay dividends, especially when they face losses. But the biggest advantage of common stocks is their high growth potential. However, this also comes with higher risk. Preferred stocks. Preferred stocks, on the other hand, are usually issued by large and stable companies. Their prices move slowly, making them more stable and less risky. Preferred stocks offer fixed dividends, meaning you receive a set payment regularly, even if the company's profits change. However, preferred stock shareholders usually do not have voting rights. They are also paid before common shareholders if the company distributes profits or even goes bankrupt. Because of this, preferred stocks are ideal for investors who want steady income and safety, but they usually do not offer the high growth that common stocks do. So, which one is the best? It actually depends on what you're looking for. If you want big growth and can take small risks, then go for common stocks. If you want steady income and safety, then preferred stocks are a better choice for you. But why do people actually invest in the stock market when they could just save their money in a bank account, especially when there is a chance of losing money in stocks? The reason is simple. Banks usually give only 2 or 3% interest per year, while stocks offer a much higher chance of growth, sometimes turning a $1,000 investment into tens thousands of dollars or even more. But yes, that higher return also comes with risk. And always remember, investing in stocks is not child's play. If you are serious about investing, invest only in companies you researched and understand. Do not blindly throw your hard-earned money into random stocks. Subscribe to Money and Habits if you learned something from today's video, because we cover more money topics every week.